So thank you so much to the organizers for including this paper on your program. It's very much a work in progress. As you can see, the title is even different than what's on the program, so it's changing a lot. It's joined with a lot of current and former colleagues. One thing I'd like to say is I think that this paper actually pairs really, really nicely with Michael's paper that he just presented, because there you were looking at restrictions on minimum payments. Here you're looking at restrictions on interest rates. And I think in this paper as well, the welfare implications are going to be sort of up for debate. Usury limits or caps on interest rates for loans are one of the oldest types of laws that exist. So here I have a quote from the Old Testament, which of course is one of the oldest written records of law. You shall not lend upon interest to your brother, interest on money, interest on victuals, interest on anything that is lent for interest. So not really a positive tone to high interest loans. And these sorts of laws persist through to this very day. So this is a map showing APR limits on 2-year $2,000 installment loans, which we're going to kind of use to proxy for just prevalence of caps on interest rates. So one thing I just want to give you a sense of beforehand, the interest rates that we're talking about here are going to be very, very high. So 20 to 30% would be low. We're going to be talking about the hundreds. In 34 states in the US plus DC, loan interest rates are capped at 36% or less. And then in 9 other states, they're capped between 36% and 60% APR. So the rationale behind these laws is essentially to protect consumers, that they could get stuck in debt traps and that this could reduce their welfare. But there's very little analysis that exists to try to get a sense of what the costs and benefits for consumers are. And that is what we're going to do in this paper. So here, we're going to ask, how do usury limits or these caps on interest rates affect borrowers? And we're going to use both individual level household credit bureau data to look at how borrowing and credit conditions change after these laws, and then individual level consumer spending data to see changes in usury limits in 5 different states from 2016 to 2021. And the key here is we're going to study how these outcomes change according to borrower creditworthiness. Because the thing is, I'm not sure, but I would guess pretty much everyone in this room is not getting 200% loans. It's really geared toward people who are not able to obtain other types of credit. So this is going to really matter for the highest risk borrowers. And not all of what we learned, I think a lot of what we learned can be just gleaned from a really simple picture, where what we do is we sort borrowers into risk score deciles. So the and risk score is essentially Equifax's credit score. So the lowest decile is decile 1, the highest decile is decile 10. And we calculate the average debt balances for each decile, both before and after the usury limits are passed. And you could see that in the lowest risk score decile, after these usury limits, perhaps unsurprisingly, debt balances tend to drop. But I think what is a bit more surprising is that for those in marginally higher risk score deciles, there's actually an increase in credit. So what we're going to find is first, again, I think that this is very consistent with what the standards theory would predict, that less credit is extended to the riskiest borrowers after usury limits. So we see credit rationing to those borrowers who are most likely to get these loans. But we see some evidence that lenders are actually reallocating this credit to marginally lower risk borrowers. And this is not straightforward because lenders could just close up shop and stop lending overall, but it seems like they're actually changing their business model a little bit. And then the third finding, which I do want to caveat, this is kind of, one, I wouldn't say this is particularly robust, and 2, we're still trying to dig into this. This is a very new result. We see some evidence of increased spending after usury limits for high-risk borrowers. So this would be indicative with borrowers actually being able to increase their consumption after the laws. But again, you'll see this result is somewhat mixed. And as I get in, just anytime anyone has any questions, feel free to raise your hand, interrupt, whatever. So I'm going to skip the lit review in the interest of time. But I'm going to just give you a sense of how these laws work. So usury caps basically ban lending credit at above certain interest rates. And these are driven by essentially, as put very nicely in the last presentation, you would say like paternalistic impulses. There's a fear that lenders are taking advantage of borrowers' behavioral biases, where these borrowers are getting into situations where they're borrowing money that's really not in their interest. So in 2007, there was a national usury limit in the United States put in place called the Military Lending Act, and essentially this banned lending at 36% or higher to members of the military, and the rationale behind this is that members of the military are, one, more likely to seek out these sort of payday loans, and two, of course, there's public interest in the US for protecting members of the military. So here I have the same map as before, and I'm going to use this to explain the empirical design that's used in this paper. So all of the states in red instituted some sort of usury limit between 2016 and 2021. Now something that's tricky here is normally you do a diff and diff where you compare to controls where there's no usury limit, but as you saw, almost every single state has a usury limit. So we identified 5 states in our sample that have no cap during this period. And to give you a sense of how these laws actually look, I have the 5 examples we have here. So you can see there's a lot of variation in the limit. So 3 of the 5 are at this 36% that's set by the Military Lending Act. And that is kind of a benchmark that is anchored on when setting these regulations. So this 36% is very, very common since the Military Lending Act. In fact, in recent months, President Biden proposed extending this 36% cap to the full population. Ohio has a smaller cap at 28%. Something to note about Ohio's law is actually kind of complicated in that there were some other things that were included in it that could be seen as being beneficial to high interest lenders. So we're going to do robustness checks where we exclude Ohio. And as you can see, New Mexico's cap is extremely high. And it's actually kind of debatable whether the 175% holds. So there's a lot of variation in how these laws work across different states. And we're going to be using 3 sources of data. So to get a sense of what the usury limits are, we use this NCLC information on usury limits, and we're going to be using the rate caps on $2,000 2-year installment loans as a proxy for the stringency of usury limits throughout the entire state. So here we're going to be using the New York Fed Equifax Consumer Credit Panel. So for those of you who are not familiar, this is a 5% snapshot of all credit reports from Equifax from United States borrowers. So if I think about the strengths and weaknesses of this data set, I think the strengths are obvious. There's a lot of information there. You're able to see a huge part of the population. The biggest weakness, I would say, just transparently, is we're missing people who don't have credit reports available. So people who don't have a credit history are going to be excluded from this analysis. And to look at consumer spending, we're going to use the Nielsen IQ consumer panel data. And what this is it's a sample of consumer spending for 40 to 60,000 consumers throughout the United States. And the way this works is similar to just like the famous Nielsen TV data set. You have individuals who basically have an app on their phone that records all of their spending. And consumers have the ability to record individual components of spending, so they can go in and record what they're spending. So there are 2 downsides with this component analysis. One is it excludes any products that don't have a barcode. So like if you go into the store and you get an onion or something like that, then that likely would not be included in the Nielsen data set. The other thing is to get the components in there, the consumer actually has to sit down and do some work to record the components, and it's completely unobservable whether consumers are taking the time out of their schedule to do that.
Could you tell us, these fading loans, are they reported to credit bureau agencies? So I know here in Canada, some things are reported, some are not, but the ones we care about, the very high interest ones, in your knowledge, are they reported in that data?
Yeah, so we've been trying to get a sense of that. Our understanding is that this is somewhat optional for those lenders, so some of them do report and others don't, but we don't have a good sense of how many do report and don't report.
And this clarification on the usury loans, does it only apply to the interest rate, or is it inclusive of all fees? Like, can you just add fees to charge more than the limits?
So it will include fees, but you could increase the balance to essentially pick up that interest. And that's actually something that we're going to see, that the average loan balances do increase.
I just mean the 36%, can I charge 36% interest rate and then have a $100 fee?
Typically no, although it does vary according to usury limit. So, because there is a lot of variation across usury limits. So for instance, the Military Lending Act, that one would be inclusive of the fees, but some of the others, that wouldn't be the case. So here I have some summary statistics on our credit panel variables, and what we're going to do here is our analysis is going to be comparing the least creditworthy borrowers in the bottom risk score decile to those in the top risk score decile, and what we're doing here is we're basically dividing borrowers based on what their risk scores were before laws were passed. So to get a sense of debt balances, we're going to look at the total debt balance that a borrower has on their books across all accounts. We're going to look at the average loan size that borrowers have on any given loan that they have, and then we're going to look at the number of credit accounts that they have open. So what's nice here is we're going to be able to look at both the intensive margin of borrowing as well as the extensive margin. And here, I think pretty trivially, you can see that bottom risk score borrowers tend to have less debt outstanding, and they also tend to have lower loan sizes, but they also tend to have more accounts. So they might have more accounts where they're not able to borrow quite as much. To look at borrower credit standing, we're going to be using the risk score, which is the Equifax credit score essentially. So bottom risk score decile, the average risk score is 518, which is subprime, traditionally subprime. If you take the old bank piece paper is 620, and this is below that. And then all other risk score deciles is higher at 727. We're also going to look at delinquencies. The way that we're going to measure delinquencies is the percent of your total debt balance that is 90-day delinquent or more. And within the bottom risk score decile, that's a lot of your debt. That's over 30%. But for all other deciles, it's much less. It's 4%. And then we're going to look at number of inquiries. Credit standing is kind of an off way to describe this. This will be a sense of both demand for credit, how much people are applying for loans, and then supply of credit. Because the way a lot of these loans tend to work is lenders will post ads on places like Facebook, and then borrowers will click on them and apply. So because of that, this also picks up the supply of credit to some extent. And you can see that in the bottom risk score decile, you're applying for loans much, much more than you are in other deciles. Now, to show you just how this data looks and to give you a sense of the sample, I have a plot showing the distribution of credit scores in different deciles for both the treated states and the control states. So one thing that you can see here, I think the first thing to take away is the groups are very similar. These distributions don't look very different for treated states and control states. So you can see that it seems like the control group that we're using, states that never had a usury limit, is pretty reasonable in this analysis. Another thing that's interesting to point out is this first decile actually includes a much wider range of borrowers than in the other deciles. So the 10th risk score decile, it seems like you have to have extremely high credit in around the 800 aside from some outliers. And the first risk score decile includes a much wider range. So the key we're gonna use here, so this, I'm calling this a difference in differences design, but our main analysis is gonna be a triple difference. I'm just using this to help ease our way into the triple difference analysis. Where what we're gonna do is we're gonna look at how different outcome variables change for treated individuals in control states relative to treated states. And here, treatment dummy is 1 if state S passes a usury limit in our sample. Post is 1 if the usury limit has been passed. And we're gonna include individual and quarter fixed effects. It's not included in the equation, but we're also gonna be controlling for age. And another thing to clarify, here, I'm gonna be going through just the pre-post regression, but in the paper, we also have the standard event study plots as well. But as you can see, I'm not gonna spend that much time on this because in the difference in differences, in the aggregate, we actually don't see much going on. And the reason for that is, I think, very straightforward. Most people don't use these loans. It's for a very specific clientele. So in the aggregate, where that includes the general population, we don't really see much going on. We see a drop in average loan size, but there isn't anything to call home about. For aggregate credit health, we see a little bit more. This I don't have a great sense of what is driving it in the aggregate. We see a little bit of an increase in risk score, but it's so tiny that it's not even worth really talking about. We see a bit more of an increase in delinquencies and a bit more of a decrease in inquiries. But as I stated, the main attraction is going to be a triple difference. So what we do here is similar to the groups that I showed you before. We divide the sample into risk score deciles, and we're gonna identify individuals that had a bottom decile credit score before the usury limit as high-risk individuals. And the intuition here is that these high-risk individuals are people who are especially likely to use these loans. Something that is tricky here is, as came up before, we're not able to see exactly which credit is these sorts of installment loans in the data. So we're gonna identify consumers who are especially likely to use those loans. And something that's really nice about this regression is we're looking at the individual level. We're looking at individual credit scores. So instead of using time fixed effects, we're gonna be using zip code by time fixed effects. So we're gonna be able to control for all time varying characteristics within a zip code. And here I have the triple difference regressions, and you can see, perhaps unsurprisingly, there is a decrease in debt for these high-risk individuals in states with usury limits after the usury limits are passed relative to other consumers. And that's equal to about 15% of the sample mean. So we see that there's this sort of credit rationing happening. Now, there's two things that could be driving credit rationing. One is you could have borrowers who are still taking out loans, but are able to borrow less on those loans, or you could see that they're just less likely to get loans overall. So when we break out the intensive and extensive margin, we see that the effect is driven by the extensive margin. We see that the number of accounts decreases by about 20% of the sample mean for these borrowers. So this is consistent with either borrowers closing accounts or no longer being able to open new accounts. In fact, when we look at the average loan size, we see the opposite. We see that borrowing amounts increase for individual loan accounts, which may seem puzzling at first, but the reason for this, if you talk to installment lenders and if you look at some of the pre-existing literature, you could see that lenders often will need to make larger loans in order to make the math work, given these restrictions on their interest rates.
So here total debt is total credit card debt or total debt overall?
Total debt overall. So it's everything. The one thing I forgot to mention, it's excluding mortgages and student loans, just because we really don't think those should be affected by this.
So just trying to square this with what you said in the introduction, that these lenders were shifting to the safer borrowers. I guess in the triple diff.
So that's going to be coming next.
Yeah, I guess when interpreting this coefficient, it could be that the high risk are taking less debt, or it could be that the low risk are taking, it's a different dip, so right, there's a missing intercept, so.
So we're gonna,
what you said,
I'm gonna
Yeah.
talk about this more later, but basically the way we're gonna deal with this is to compare those safer borrowers to all of the even safer borrowers. So we're gonna exclude the high risk guys from that analysis. So when we look at the credit profile, what we see is that we see an increase in risk score, so this could be consistent with credit conditions getting better for borrowers, but that doesn't really square with what we see in delinquencies, which is a really big increase in delinquencies. We see an increase in delinquencies equal to about 60% of the sample mean, and the explanation for that would be that if you talk to installment lenders, people tend to use these loans for debt consolidation. So they tend to use these loans to pay off other debt. So this could actually be capturing spillovers to other markets. We don't have this in the paper, but we do see delinquencies in other markets, like mortgages and, well, mortgages actually no, but like auto and credit card, those increase surrounding these laws. And we see a decrease in delinquencies that's quite big. It's about 20% of the sample mean, and this could be driven by either decreased supply of credit, where these lenders are advertising less, or decreased demand. So now, of course, if you do a triple difference analysis, you have to make the parallel trend assumption, which is that in the absence of these laws, credit conditions would have stayed the same for everybody we're thinking about. So we plot event studies to think about this rigorously. When you look at the debt balance outcomes, you can see that there doesn't seem to be any differential change in any of these outcomes really prior to the law for states that have these usury limits relative to control states. And you see the effect is actually quite immediate. It seems like pretty much immediately you have this credit rationing occurring, and then you see it continuing afterward and growing. When you look at the credit standing, it's actually a bit more complicated. The result we were seeing in the risk score seems primarily to be driven by a pre-trend. You can draw a pretty neat line between -4 and t equals -4 and t equals 5. So it doesn't really seem like these laws are causing an increase in risk scores. It does seem that you have a more robust result with the change in delinquencies, where delinquencies are increasing, and the decrease in inquiries. So now we're going to get to the question of the reallocation. So one question that we had throughout this project is, how are lenders responding? If lenders are told that they can no longer make these loans that were their main business model, what are they going to do? So there's two ways that they could respond. One is they could just close up shop, leave the state, because there's no way that they could be profitable in this business environment. But the other is they could actually change their business model. They can lend to more creditworthy borrowers at lower rates, where previously it wouldn't have been profitable to do so. And to be clear, for this story to make sense, lenders have to have some sort of a capital constraint that prevented them from making these loans previously, where they only had enough capital available to lend at the high interest rates, but couldn't lend to everyone they wanted to.
So just a question, is this really a situation where normal banks are not making these loans? These are specific providers who aren't really like tied into usual financial institutions. That's the case here in Canada, right? They're very much, there are guys who do this and there are guys who don't, the big guys don't do it. And so we're not talking about them shifting people between products within their own portfolio. This is different people who, when you're saying they're going to leave the sale or something, they're going to keep that same business model with just these high interest rate borrowers and move.
Yeah, so it would be that they would move to another state. So that is correct. They're typically non-banks, but they often do operate in multiple states. So.
Do you know if they do a lot of different products, or they're just like, we have one product, this is the product, we're charging you all the same price, or there's a lot of heterogeneity within that?
There's heterogeneity, but not that much. They're not making like fixed rate mortgages, but there is some heterogeneity.
Thanks.
So to think about this carefully, we're going to look at how lending changed for borrowers in the second, third, fourth, and fifth deciles of risk scores. An obvious question is, if we look at these borrowers, we might just be picking up the change in the high-risk borrowers. So to do that, we're going to compare each group to all of the borrowers that are relatively more creditworthy than them. So we're going to take the borrowers in the second risk score decile and compare them to all the borrowers in the third through 10th. And we're going to take the fifth risk score decile people and compare them to all the borrowers in the 6th through 10th. So the results are here. Deciles 3 through 5, you see a pretty big expansion of credit. You see that credit increases by about $1,000 to $1,300. And it seems like it hits its peak in the 4th risk score decile. Of course, if you go up to a certain point, like we've made this for basically every group, at a certain point, this goes away, somewhere around the 8th risk score decile. You don't see an effect. What's interesting in the 2nd risk score decile, you don't see anything going on. And the reason for that is we believe that somewhere in this decile is that marginal borrower, where below that point, they're being rationed out, and above that point, they're now in this new group that is receiving loans, where previously they might not have been going to this type of lender. What's interesting is we see delinquencies increasing for this group as well. To be honest, we don't have a great explanation for why delinquencies are increasing for both the group that's getting the new credit and the group that's losing credit. That's something that we would like to understand. And inquiries are decreasing for this group as well. So that is also something that we're still trying to get a handle of. Just in the interest of time, I'm showing you the table rather than the plots, but the plots are all on the paper, and generally speaking, there isn't really a pre-trend for these guys. So we've spent a lot of time looking at borrowing and credit conditions surrounding these usury limits. We've shown that for the borrowers that are most likely to use these loans, they receive less credit after the laws are passed, and for marginally more creditworthy borrowers, they actually receive more credit. But sort of the most important question that you could ask here is, how is consumption changing? Because the reason people get loans is to consume. So it's possible that usury limits could either decrease consumption if you needed these loans to buy things. And to be honest, ex ante, this is what we were expecting to see. It's also possible that if borrowers are trapped by high cost debt and servicing the debt, paying interest at high rates, that they're able to spend less money. So these usury limits could increase spending for affected borrowers. What we're going to do is we're going to use the consumer panel data from Nielsen to see how spending changes after these usury limits. One thing that's tricky here is, of course, our main variation is going to be coming from the risk score of individuals, but we're not able to see the risk score in this Nielsen data. So what we do is, for every zip code, we calculate the population of borrowers that are in the bottom risk score decile in the CCP. And then we're going to find the top decile population of bottom risk score decile people. I know that's a mouthful, but basically what we're going to do is we're going to identify zip codes where there's a lot of people with really low credit scores. And we're going to compare people in those zip codes with really low credit scores to people in other zip codes. So summary statistics we use are here. So we have total spending, which is exactly what it sounds like. And then something that's really nice about the data that we are still working on exploiting more is you can see the components of spending. And you can't see this for every transaction, but you could see this in a really, really granular way. So you could see if somebody's buying organic eggs or just regular eggs. You could see if they are buying cigarettes, which brand of cigarettes they're buying. You could see really everything about certain transactions in this data. So we identify spending that can be categorized as food or non-food, and spending that we can be categorized as essential or non-essential. And of course, the essential, non-essential, that requires some discretion to categorize. Another important caveat is you'll notice that the total food spending and total non-food spending don't add up to the total spending. That, as I said before, is because one, we're missing every transaction that doesn't have a barcode. And two, there could be people who, for all sorts of reasons, just don't go through the extra step of adding details on their spending.
This is really, really detailed, but what if I'm in this lowest group and I need the money to bail out a family member from prison? Or I'm buying drugs and I don't want to put in a barcode. So I just wonder whether in that group there's some spending that is not our normal Amazon and the supermarket.
So yeah, that definitely wouldn't be picked up here. So the Nielsen population, that includes 60% of retailers in the U.S., I believe, or retail locations, and that is mostly going to be places like grocery stores or places like Target.
So what about pharmacy, like medical spending?
So if it's exclusively pharmacy or medical, it wouldn't be there, but like if you're buying pharmaceutical goods in a supermarket, it would be included. So this, I would say, this data source, I would say, is best for like non-durable spending that you could get at the grocery store.
Do you have an estimate of how much of the household expenditure in this group that is using predatory loans is captured by this, and how much we missing, like how much of them do you anyway to estimate? Is this 80% or 60%?
That's a good question. I don't exactly know, but I mean, we're definitely missing quite a bit. And one thing that we wonder is actually if something we're trying to get a handle of is if durable consumption is going down. So we might expect that those sort of things like healthcare expenditures would actually be dropping, the really expensive spending.
It's just in this group, there's a different household finance going on than in other groups. They may have family members or they have expenditures just don't show more. So it's,
Yeah, I mean, some of that, like giving money to family members, that there's no way we could ever see, certainly. But we have explored other data sources to think of things like spending on cars or healthcare. So we start off with a difference in differences analysis, which again, our expectation ex ante was that we wouldn't see anything like with the CCP. We actually see a drop in the spending here, and to be perfectly honest, we don't have a great explanation for this. So that is something that we are working on trying to understand. And it seems like for the most part, these results are not driven by a pre-trend, and you see the effect to be pretty immediate. Now, when we look at the triple difference, which is the more interesting side, we see that there is an increase in spending for zip codes with a high population of risky borrowers of about 5% of the sample mean. So this is consistent with the story of individuals have trouble servicing the debt of these loans, and this reduces their consumption. What is tricky, though, is when you look at the components, the message we get is actually kind of mixed. So when we break out food and non-food, we see that this increase in spending is in food, but for essentials versus non-essentials, we see the increase is more in the non-essentials. If we look at the event study plots, if we look at all spending, that looks fine. It does seem like that result is really there. The increase in food, there seems to be a bit of a pre-trend there, although the effect on non-necessities, that seems like there is not a pre-trend. So our sense is that we do see an increase in spending, but we don't really have a good sense of why that increase in spending is happening, and that is something that we're actively working to understand. So we do quite a bit of robustness. I'm not going to spend a ton of time on that. So when you do a triple difference, I think something that is a bit confusing to everybody is you have 3 interactions, so what's really driving the variation? So one thing that we do is we just do a diff and diff within the treated states, comparing the high-risk borrowers to others. and the results hold. And this one isn't in the paper, but another thing we've done is just look within the high-risk borrowers and compare treated to non-treated, and that also looks very similar. As I stated before, Ohio's law is a little bit weird. There's a lot of details and intricacies in it. The results hold when dropping Ohio, but I should be careful. The borrowing and credit conditions results hold. The spending result actually goes away. So when I mentioned that result isn't quite as robust, that's really what I was getting at. And I think the big elephant in the room is that 2 of our laws, including for Illinois, which is a really big state, happened during the height of the COVID pandemic. So obviously you can be concerned that the pandemic and the government's response afterward could be driving the results. But we do a version of the test where we drop all the COVID years and things seem to hold. Another concern you could have if you understand the details of these laws is that states that don't have usury limits may have things like usury limits. So for instance, some states have these laws that you're not allowed to make unconscionable loans, but there's not a definition of what unconscionable is. But the legal literature shows that Wisconsin and Utah have a long history of having no usury limits. So we do a version of this test where we use them as controls, but nothing else. And the spending results hold if we do an alternative weighting to make the sample proportional to the state populations. So just to conclude, these results show that, as expected, lending decreases to high-risk borrowers after usury limits, but a lot of things also happen that you wouldn't necessarily expect. So in particular, we see that borrowing increases for these marginally lower risk borrowers, and you see an increase in spending for the high-risk borrowers. So our big takeaway is kind of the response of consumers to usury limits is actually more complicated than what the theory would predict. And it's a pretty interesting picture that we see. So we have quite a bit more to do. So the biggest thing that we are interested in is we have this change in spending, but we don't really have a good sense of why it's happening. And we don't have a good sense of what spending is driving this. So we want to do more work here, and I'd say the biggest thing that we want to do is, so as we discussed before, the Nielsen data is missing some important types of spending, and this makes it a very particular picture. What we find to be most concerning about the Nielsen data is it basically has no durable consumption. It's all non-durable consumption. So we want to get a sense of if this increase in spending is associated with some sort of a change in non-durable consumption. So that, I would say, if I had to put one big thing on our to-do list, is what we have. So thank you all, and I'm looking forward to Felipe's discussion.
Hello everyone, thanks for the invitation. Thanks for the presentation in the paper on a great topic. Usury limits are very important in the sense that we've been debating whether they should or not exist almost for the existence of mankind, like Lee showed. And it's very important so that we can do consumer protection right, so that we know what are the effects of usury limit. And it's very important at the same time that we keep incentivizing the efficient provision of credit, that we don't go and harm the lenders because they do have then the gun that can harm the customers. What we know already is that you put a limit on the interest I can charge, and I say, well, then high-risk loans are not profitable anymore for me, and I cut credit to those. That is known. They confirm the results. They do it really well. It is known. It's in the literature. I've been with Brian Mullen and Tom Miller on this credit for me, but not for D paper. They show it amazingly as well. So high-risk borrowers lose access to credit. We know that. The ambition that this paper has is actually very cool, which is, sure, high-risk borrowers lose access to credit, but they also lose the burden that high interest debt places on them. This is the tension. And then the authors bring, okay, but do they eat more or less? Do they spend more or less? So they use spending to flesh out costs and the net effect of costs and benefits of usury loans. And this is pretty cool. Now, I'm going to start by giving them kudos because they do so taking liquidity constraints seriously. We usually model our intertemporal budget constraint. We say this is all the person is gonna make for a given number of periods. This is all they possibly can eat. Now they'll use financial products to allocate savings and debt to bring that consumption in time. But honestly, if you don't have the money now to spend, you cannot eat now. So the liquidity constraint matters. I have work showing that your propensity to overdraft dramatically changes depending on how frequently I pay you. I have work showing that when you enroll in Roundup savings, just that Roundup makes you overdraft more. So I really like papers that take the liquidity constraints seriously because they bind, and we know that. The results are what we showed. The definitive results, modest effects on everything, equally modest effect on spending. We do see spending decreasing. And you know, if we stop here, we get to where we are, which is, oh, usury laws actually are bad because they cut credit to people, people cannot eat. Liquidity constraints fine, we stop. They go further, let's skip this. They go further and they do, okay, but what we care about is those most vulnerable consumers. They're usually also high risk, which is an assertion one can make. And when we look at a triple diff, what the paper says is high risk borrowers actually have fewer larger loans, leading to a lower total credit. $2,000 of less credit, that's enormous. Then they see increase of 22 points of credit score, that's also enormous. And 4 percentage points of delinquency, it's also large. 3% of the mean consumption, an increase. Their figures are now a little bit different because they use the Nielsen weights. I guess that's the difference.
Yeah, we switched or it a little.
But it even got bigger, so it's no problem. These aren't large amounts. Here's where we start learning that something is going on. Now, again, I love taking usury laws seriously because they are important, and I love taking spending and liquidity constraints seriously. So that's going to be my comments. First, are usury laws limits on the price of credit, especially for high-risk customers? This is the list of laws they have, but if I go to North Dakota in 2022, I do work on payday loans, and so I had a hard time finding the laws for payday loans. They usually appear with a deferred presentment term in the, I have no idea what it means, but if you want to search for payday loan laws, search for deferred presentment, you're going to find all of them. And even though North Dakota has a 36% limit, passed as of 2021, in 2022, deferred presentment laws, the fees for service, led for a fee not to exceed 20% of the amount paid to the customer by the licensee to be charged. Payday loans are very short. They're 2-week or 4-week loans. 20% over a month. This is no longer 36%. The 36% are not binding here. Okay? Moreover, they say this fee may not be deemed interest for any purpose of law. So, yes, lenders, you can charge whatever you want and we're not going to call it interest. You're still complying with the 36%, and Taha was actually asking this. Ohio, I know you remove Ohio and your results hold, but in Ohio, it's all the same law. You cannot charge more than 28%, it is in there, but then you can do a bunch of stuff. You can do a monthly maintenance fee that should be the lesser of 10% of the original contracted loan amount, or $30. Then you can add 2% as a loan origination charge. Then you can add $20 as a check collection charge, which in a small loan makes it way more than 20% interest charge. And I could keep going on and on. So I'm going to send you this. These are the list of laws that I had to read myself to learn about this. They are all, as of 2019, for research purposes, but you can easily find them and update them. Now, turns out that these are the laws that bind. These are payday loan prices, distances from the law, from the actual price of each loan to the law that applies to that loan. Why am I that specific? Not only because of state, but a lot of states have their laws depending on loan amounts. So for each loan, I need to go and make the law that applies to that loan. They bind, and they bind gigantically. My most surprising fact was that for online loans, it also binds. Even though they could reallocate geographically, saying where they are, it also binds. These laws are the binding ones. And trust me, they're much larger than 28, 36, or 175%. And these are the laws we care about. Mississippi, they have an usury law not introduced during your sample period, much older, 36%. They also have a deferred presentment law on their check cashers act of 20% for loans up until $100 and $21.95. What happens if I plot prices? Of course they bind, 20 and 21.95. These are the laws that bind, not the usury laws, even in states with usury laws. That's my point by using Mississippi. Mississippi isn't even on their paper. Okay, so my suggestion is go think deeper on what these usury laws mean, what they're leading to, who and how they're affecting. Because for now, the assumption in the paper is that usury limits should be most constraining for households that do not have access to traditional credit markets. And no, they're not at all. If I don't have access to traditional credit markets, I go to the payday lenders that can charge me whatever they want. That's what those laws say. Up until a most enormous limit. That binds. Okay? Now, diff and diff. First, on diff and diff, let's talk about the control states. This is a snippet of my table. We need to think about having one of two options. Either we want control states to be never treated with any kind of fee cap, and then the paper becomes about capping interest at all, or we want for each treated state a control state that has the same fee caps, and then the paper becomes what's the effect of usury laws alone. Okay? The control group will have to be redefined thinking about this. On control variables, I dislike the linear control on age. One could do age means let it be more flexible. We know credit follows a life cycle. We know anything in finance follows a life cycle. Controlling linearly on age, I didn't like. And I don't think Equifax has modeled income. And I think income becomes to be a vital part of the credit usage. And if we want to compare credit amounts, we need to take income into account. Now, the abundance of quasi-null results on the diff and diff shows me that either user limits are not that binding, I would expect them to be, or I expect results to show that they were, or that they're binding on the extensive margin, that credit gets too expensive, I can no longer lend to a bunch of people, but then they disappear from my database and I don't see them. Okay, so there's a simple composition effect that might be going on, and this would explain the increase in credit score that we see. Only the good ones stay, the average credit score of the firm goes up. But the affected ones, did it improve for them? We don't know, because they disappeared from my sample. And mechanically, with less loans, I would also see delinquency rates going up. And that would explain the puzzle of credit score going up and delinquency going up as well. Then your very rich set of fixed effects that I think you should keep will absorb the tweak and the post dummy. But then, especially for the triple diff, like Tahoe was saying again, we don't know what's happening on the other margins of adjustment form, just the tweak, just the post. And so at least what I suggest is show us raw plots of means, show us what's happening, and do a first stage. If the effect is on prices, we want to know if prices changed. Okay, and I know prices are complicated on consumer credit panels, but we do see payments, we do see loan amounts, and with a little bit of financial knowledge about the loan structure, we can say, I don't see prices, but I computed these numbers for you. And if they're all computed the same, at least we'll see some debt servicing burden, if you want to call it. Again, to solve all of this, I would, for each treated state, build a synthetic control with exact conditioning on having the same fee cap structure. And then out of the allowable states with the same fee cap structure, build a synthetic control and evaluate the impact of usury laws. Because you have the right ambition, the right curiosity, and we need to know. On spending, it changed. Gonna go. Oh, Nielsen scanner data. It is pretty cool to know about quantities and prices separately. Are people eating less cans of soup or cheaper cans of soup? Okay? Use the richness of your data. That's the power of scanner data. If it's just about spending, you're bearing a lot of costs about unobserved spending that you could solve with transactional level data. So if using scanner data, tell us about quantities. Are the people getting the same product at more expensive stores just because they now need to go to the predatory loan store? Now they also go to the predatory grocery store that doubles the price of the can of soup. This is important. Definitive credit. I don't know how with zip quarter fixed effects one gets a treated times post coefficient. It should be fully absorbed. And if we do, then Tahoe was right in the sense that a triple diff of minus 1900 compared with the 3 times post for those that are low risk of 5600 would tell me that indeed they're increasing their debt less. They're not reducing their debt. So I did something. I told my imaginary friend, can you simulate a data set in which this happens for us to understand what's going on? And I can get a similar coefficient that the one they get when I do the triple difference. But then, if I run it just for low risk, I see them with a similar coefficient. If I run it just for high risk, I see them increasing their consumption, but less. Okay? I also went on another table that they do, let's do this just within treated states. So, with the same data set, I condition on treated states and definitive. And again, I do get a negative difference, but it is because they are increasing their debt less. Okay, the baseline increase you see here is much larger than this definitive. Okay, so again, learning all the components of definitives is important. On triple diffs, even more important, so that we understand what's going on. And again, these all in the name of good usury laws. Then the bonus track is, we need to think about the alternative. If these folks are being ruled out of the sample, ruled out of credit markets, where are they going? They might be going, again, to payday loans where the usury limits are not binding, and so we need to think deeply about it. They also might be going to the informal credit market, borrowing from family and friends, borrowing from people that are not even their family, and much less their friends. Okay? And so, usury limits might be increasing debt prices for those that we think are most affected by them. And I encourage the authors to think very deeply about all of this, and I think the paper is easily going to be publishable because it is taking liquidity constraints into effect, and it's solving the trade-off of access to credit and liquidity with spec, and it's pretty good. Thank you very much.
Thank you, Felipe. That was a really great discussion, very thoughtful, and clearly you put quite a bit of work into it, so I appreciate that. Going to talk a bit about the usury laws, because that I think is probably the key part of the discussion. I mean, I'll fully acknowledge this isn't, there's a lot of laws about this stuff, and the lingo is very complicated, so I've tried to become an expert on this, but it's a hard area to become an expert on, so point taken, and this discussion is going to be a really good resource to learn more about how these laws work so that we can take it more seriously. And then a couple points that, I mean, everything here was great and useful, but a couple points that I have simple explanations for. So the Equifax income, the Fed does not currently have that variable, but I've heard rumors that we're going to be getting it soon, so hopefully eventually that will be a control in the paper. The reason why we see the treated by post coefficient for the zip by quarter fixed effects is in the CCP that's picking up movers, so people who are moving essentially from one zip code or one state to another. Where the treated dummy is defined before the law passed, but they could still move from other zip codes, so that's just the explanation there. But yeah, happy for all of the questions.
Many questions. So my RA at the back is currently doing the Canadian version of what you're trying to do.
Oh wow.
He's done more in a basket shift share way, but the essence was that some questions that came were, have you tried looking at addictive or risky products? Because one thing we really wanted to almost do in the survey was, are you someone who gambles? And this is something you just raised. Because if you can prove, like you raise cigarettes, they're a great example of, are you someone who is taking risk? And that's why I was really surprised you didn't pick out medical insurance coverage, because I'm guessing that's a key source of these things that you need to consume right now, and it's very prescient. And the areas you're picking out with the low income areas, they should have very bad UI coverage, and they should have very bad medical insurance coverage. The other thing is UI laws are often very, very correlated to the usury laws, and I think you can use that. It's a really, like the exposure of the household. And then there might be a degree to which you can make an argument that these laws are regularizing markets and people can operate in more jurisdictions. and that competitive element might be important. And then, because I've spoken for way too long, I just say it's a really great paper and really very interesting and yeah, fantastic, especially with the liquidity constraint finding and the frequency. I would warn you that the Equifax income variables, people for these kind of loans often report transfer or benefit incomes as their income, and the lenders let them, I won't say get away with this because they don't care where the money comes from. So whether this is actually income for these kind of people is something to be taken maybe with a grain of salt.
Like, I mean, I'm sure if you and your RA are working on this, I'm sure we'll have a lot to talk about during the meetings. But one thing in particular, the addictive/risky products, I'm glad you brought that up because that is something I've been pushing my co-authors that we should try out.
So thanks for this. You know, even this slide kind of highlights that. Before I really go into this literature, I would think that people taking out these kinds of loans are people who are, you know, very different from me, and they just inherently want to borrow more money. But like this screenshot shows, right, it's typically average people who just find themselves along these loans. So kind of to push back and almost defend you a little bit on in terms of this risky behavior, it is included that the average person getting a payday loan is doing that to bail out a family member or for risky behavior. But I wonder if you could motivate that a bit more and just tell me in your sample, which is a relatively selected sample because there's people who have credit profiles like TransUnion or whatever. What do they look like? Is it really people who are super poor, super uneducated, whatever you can do? Or is it just the average person who finds himself needing this high interest rate loan one time? Because that'll resolve a lot of what we discussed about.
Well, that more descriptive stuff is actually another thing I'm really pushing my co-authors to do more of. So thank you. One thing that's really tricky, I'm sure if you're using the Canadian credit panel, you get this, but like the biggest problem with credit panel data is it has very little stuff that doesn't have to do with credit. So we can do more to just explore their credit profile, but a lot of that other information would be tough to see. I mean, the thing that we could do with the spending, I wasn't thinking about looking at risky spending in terms of saying that there's something wrong with these borrowers, just to try to get a sense of what margin they're changing their spending on. But yeah, I mean, I agree that the more we can teach people about the sample, the more we're going to be able to learn.
And just final thing on that is you could also look at the spending data and say this person's spending profile prior to getting the loan looks like the average American. And then when they get the loan, it's because there was an expense shock, for example. There's a cool paper about how expense shocks do matter. So I just want to have it in the back of my mind. And what I've learned in this literature is that it's not people who are, you know, quote unquote bad people who are whatever doing. It's normal people who for whatever reason need the one bad loan. And that really changed my perception about why we should be worried about provisioning this kind of credit properly.
Yeah, that makes sense.
Okay, cool. Next question?
Yeah, so I will assume like a lot of those credit lenders, like those banks, they're nationwide and they operate in different regions. So I just wonder, do you observe that, you know, like the bank charge a higher rate, you know, for the high-risky borrowers for the non-treated regions for compensations?
So unfortunately, one, I think probably the biggest shortcoming of the CCP for our purposes is we're not able to see the lenders. So we're not able to do that. We had initially this project initially started with loan level data that we had gotten from like an installment lending industry group for 2 installment lenders, but the 2 installment lenders that they gave us left the state after the law was passed, so you can't do a diff and diff with 0 post observations, so we ended up having to switch, but we wish we could do that.
Cool. Thank you so much.
Thank you.